Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We're here with our resident uranium expert, Justin Huhn of Uranium Insider. Justin, thank you for coming back on the show.
Always good to see you, Steve. How are you?
I'm doing just fine, sir. I've got my patented uranium tie on here, although a lot of people said after our last episode that it should be yellow, not red, and maybe they're right.
Yeah, start wearing a green tie. All right, enough. No more red.
I wear green for most of my other interviews, but I figure like I need to differentiate somehow when we talk uranium because it's so special. It has just such a good place in my heart.
I understand.
Yes. Okay, let's start out like we always do. What is your macro view of the uranium market today?
So we've been going through our modeling numbers as we always do. This is something that is constantly updated because it's constantly changing. And the outlook really has not changed very much, with the exception of the increasingly likely scenario where more and more reactors that are set to shut down in the next 10 years are extended, and to speak generally globally. So the overall macro view essentially is that we continue to have a deficit in the market, and that deficit is only balanced in theory 4 to 6 years from now, if projects that have not yet put a shovel in the ground do develop. And the problem with that picture is that multiple of these projects will not be developed at these prices. So while the companies are generally saying, okay, we've got final investment decision and we're gonna progress towards development, I'm telling you that some of these lower grade, higher cost projects, they are not going to happen in this price environment. So right now, what we see in that environment is prices still have to go substantially higher, or we will not ever see a market balance in this sector. And the reason that we've had a deficit and have been able to, for the reactors to continue to operate, is basically there's large inventories in the world. Most of those inventories are sovereign inventories, strategic inventories, or are held by the commercial reactor operators, basically inventories that do not come into the market. Some exception to that has been Japan. Post-Fukushima has sold down some of their inventory. But there's been a lot of above-ground mobile inventory that the sector has worked through. And despite working through 95% of that material that existed 6, 7 years ago, which we've seen the prices rise substantially. So you don't see prices rise in an oversupplied market. That's a very simple situation. But really, big picture, broad view is nothing has changed. We have a deficit. We need higher prices. The equities have been severely underperforming, although they've essentially been tracking the spot price, which has overshot term and is now pulled back down below term. This happens. It's happened multiple times in this bull market already. It's happened in the previous market. Yet the term price continues to chug higher and or consolidate, chug higher and or consolidate. And so we believe we're coming close to the end of that consolidation period for the term price, because it rose for the first 7, 8 months of last year. And then it's been essentially flat for about the past 5 or 6 months. And meanwhile, spot has gone on a moonshot, came all the way back down. Now, despite very low volumes trading in both markets, we have spot seemingly stabilizing here, kind of in the mid 60s. And with term right at about at 80, it was flat again. It was reported yesterday by UXC, no change for the month of February at $80. I think it's 82 with Trade Tech. So with term at that price and with spot here mid 60s, a little bit of utility demand in the midterm will engage the carry trade, and that actually is happening, which is a good sign. We're seeing the carry trade start to pick up. So not calling a hard floor here in spot, but the evidence is showing that volume has basically dropped off a cliff, and the price is starting to stabilize at these levels, which is a very good sign. And we're also at the end of the month, so where's the smash? Not seeing it. So with all of that said, the industry and the investors seemingly, so that is to say utilities actions or lack thereof, volumes traded spot and term, and then of course the equities, all seem to be waiting for clarity on multiple fronts, but most importantly, what the heck is the Trump admin going to do? So the entire U.S. utilities fleet, while there is some volume being traded over the previous months since he was elected in November, there has been some volume traded in the U.S. utilities in the term market, but it's been smaller. Most U.S. utilities are on the sidelines here, wanting to know what the heck is going to happen with the investment tax credits from the IRA, which as of this point are frozen currently. Are they going to be extended? Will they be rebranded into some other pro-America, whatever it is, energy dominance policy? We don't know. And the tea leaves are reading that something bullish is coming from the administration. The language coming from Chris Wright, the new Secretary of Energy, the fact that Trump has surrounded himself with essentially nuclear bulls, and multiple statements about the importance of growing electricity production in the United States. I'd be happy to share some notes from the NEI Nuclear Financing Conference that I attended the week before last. A lot of good takeaways from there on this front, but it looks like something is coming. We just don't know if that's tomorrow or next week or next month, because what the admin is doing right now is cutting everything with a machete with a blindfold on. So what that looks like, that doesn't bode well for kind of thinking that they're going to throw an insane amount of money at building nuclear or doing anything at this point. So the industry, the utilities are all waiting on this. Now, the good news is they can only hold their breath underwater for so long, to quote Scott Melby, right? They have to come back to the table in higher volumes. And if you look in the past few years, certain entities, the Chinese, certain utilities in Europe have been doing exactly that. They are buying aggressively. They are looking at acquiring projects or acquiring projects, new joint ventures, things like that. So the Chinese are thinking in decades. The Western utilities, especially in the US, they're worried about their next Russian delivery. They're not sure what Trump's going to do. And the Chinese are like, I'm your Huckleberry. Let's cover in 2045, right? So it's a whole different mindset. That's kind of where we're at. A period of stagnation following a long period of consolidation for the spot price, a long period as well for consolidation for the term price. And we're coming to an inflection point. And that inflection point, from what we can tell, based on our numbers and our own modeling and the direction that the rest of the fuel cycle has gone, that inflection point is going to lead to a move up. And we think that next move up is going to take spot to a higher high, followed by another period of consolidation to a higher low. It just takes time. And this sector will test your patience like never before. Meanwhile, the equities are now at RSI 28 or whatever it is. It's a screaming buy in my estimation. Before we were on this call, that GIF with the mouse with the cat at the keyboard going, that was me on my trading platform. So this is a full-on capitulation moment. We've seen this a few times in the past years. This is about as worse as I've seen it since I've followed this sector. For 10 years, I haven't seen sentiment this bad besides maybe the COVID crash. And even that was kind of general fear across all markets. This is people throwing in the towel thinking this is over, this trade is done, and they couldn't be more wrong.
Okay, I'm going to share my screen here, and this is what you're talking about here with the spot and term price. And so this is from our friends at Cameco going back to the 80s. Here's the uranium spot prices in blue, and the black is the long-term, the term price. And so if we zoom in here on the last few, I don't know, the last decade or so, we can see that the spot price was cheaper than the term price. And then we got these little gifts here where it went up above. And then the last one where, it went up north of $100 on the term pricing, and spot basically just had, spot went north of $100 and term pricing. And then now the alligator jaws have kind of reversed, and we've got term pricing at 82 and spot pricing right now, I think, is at 64 or 65. You see this arbitrage being closed is basically what you're saying.
Yeah, it'll happen again. We'll see another spot overshoot. It's all about the momentum. It's all about the trend. And in normal market conditions, that is to say, when we're not in a strong uptrend, both in sentiment, in volumes traded, in spot and term, and of course in price, When that happens, you'll see an overshoot. But when we're not in those moments, normal market conditions will see the spot price down below the term price. And, the traders are that connective tissue between those markets, especially with the carry trade. So utility coming out for 500,000 pounds or £1,000,000 demand 2-3 years from now, that actually glues those markets together. They'll engage with the trader to sign that kind of midterm contract, lower volume, and they'll come into the spot market and cover it off. And that's exactly what we're seeing right now. Still not big volumes because of multiple uncertainties, primarily around Trump admin policy, Russian deliveries, and of course, questions about what could happen with the war in Ukraine. Hopefully, that will come to an end at some point soon. It seems like that's something that Trump is working on somehow. Seems like he's friendlying up to Russia. I think that has people really scared and thinking that we're about to see megatons and megawatts part two, and all of a sudden 20 million pounds come flooding into the market every year, which physically cannot happen. But all of these things are adding to either fear and frustration in the equities markets or stagnation in the physical market, and these are all temporary phenomena. But yes, once that trend shifts, and it's so interesting because it's such a complex market, but a lot of times what can be explained more simply in the physical market is literally just momentum and trend. And when the trend is up, sellers pull back, buyers step in. And it's counterintuitive to the contrarian investor mind, but that's how they operate. There is no incentive for a utility to try to catch a falling knife. And the utilities don't want to touch the spot market because right now it's working for them, that trend. The trend in the spot price has been down for the past number of months. And how is that good for them? A, it's going to influence their negotiations for long-term contracts. B, it's going to allow for the deliveries of legacy contracts that are at least partially referenced to the market to be cheaper. So that works for them. They have no incentive to be like, oh, it's 65 here. Let's jump into the spot market and buy £1,000,000. Like, nobody's doing that. There's no incentive whatsoever to do that. They need uncertainties gone, and that alone will bring many more players into the market. It doesn't even really matter what the price is. Once we know and we can plant our flag to our operations in the next 5 years, we're coming back to the market. And the U.S. utilities, the Southeast Asian utilities, let's say Japan, Korea, they're not that very well covered. And so there's a lot of utility demand that has to come into the market. Can they stretch it out another month or two? Of course they can. Of course they can. Inventories always give a little bit of buffer. But if you look out midterm, long term, there's an enormous amount of uncovered demand that they have to cover off. That's going to lead to higher prices because at least what we can say over the past years is when demand comes into the market, the price responds. So we have these periods where the utilities largely step out, and the term price consolidates, spot consolidates, and then it doesn't.
Okay. All righty. I think that answered Ted's question on SPUT. And you said you got some notes from your recent, what was the conference, the NEI?
It was the Nuclear Financing Summit. It was in New York City the week
Okay.
before last. Yeah. And so I attended this, and this was not a fuel conference. So a lot of the mining companies were not there. A lot of the investors that are typically invested in the mining stocks weren't there. It was mostly finance. So like big banks, tech companies had reps there, and all of the discussion really was around the growth of nuclear. And it's just a really, really obvious theme at some point, and which is such a stark change from the previous decade. I mean, these conferences were dead in the 20 teens, like absolutely dead. And and now it's just this foregone conclusion that nuclear is going to grow at 3 or 4% per year compound annual, which is insane. A lot of because it was based in the U.S., a lot of the conversation was around U.S. and growth in the U.S. And there's just too much uncertainty out of the admin. So once the progress that was made in the Biden admin, especially with the DOE, the loan program, the clean energy production tax credits, which aren't as meaningful because all of these utilities are selling, expensive electricity, and they're doing fine on that front. The investment tax credits are key for decisions around building new nuclear. One thing that was absolutely solidified at this conference was that the tech company interest in nuclear is absolutely there. So this is not theoretical. This is not the tech companies going through an ESG box checking exercise to say, yeah, we'll throw 500 million here and 500 million there. It's some kind of advanced nuclear SMR, whatever, just so we can say, yeah, we're into this, but really we're going to go balls to the wall on gas. Multiple times mentioned by people who absolutely know this industry, basically stating the growth projections that we're seeing and we believe we are going to have to meet cannot be met with gas and solar and storage alone. It physically can't happen. So it's not like this, oh, gas is easier, and despite the fact that it's a quote unquote fossil fuel, that's going to take care of the problem. No, it can't. There are limitations with turbine availability. There's limitation with pipeline size and location. Not to mention, it doesn't look good for the companies to just go all in on gas just to get their needs met on the electricity front. So we need an all of the above strategy. And the interest in nuclear is huge. So there was a representative from Apollo, 750 billion in assets under management, three-quarters of a trillion AUM. They want to invest 100 billion into the nuclear industry. And
Wow.
they're ready to write that check. Okay.
Okay.
So, which is an insane amount of money. The only issue is they don't want to take the risk by themselves. So there's a lot of work being done right now, pulling together all of the parties, the US government, the big banks, the tech companies, the utilities. There's multiple of these private companies known as developers, which are just kind of emerging right now to fill that need, connecting all of these players to get new nuclear built in the United States. And there's so much momentum around it. So we're really excited about what's going to come out of the admin. We don't know what it's going to look like or exactly when it's going to hit. But much of the discussion was around tech company interest, nuclear growth, finance interest in this industry, and how to pull that all together.
Okay, so if one fund was talking about putting in $100 billion, we've thrown this question around before. What's the current market cap of uranium? And we've come up with numbers anywhere from 40 to like 80 or 100 billion. So that they're basically talking about doubling the market cap of the entire uranium sector as far as what they could invest.
Yes, I mean, well, I should clarify as well. I mean, I don't think Apollo is looking at buying URA or URNM, right? They're
Yeah.
they're talking about funding building nuclear plants.
Okay.
They're
Okay.
talking
All
about
right.
investing in the actual industry to build the nuclear plants and
Okay.
to build out the nuclear fuel cycle potentially as well. So just to spread it out generally. But with all of that said, had conversations with I'll keep them anonymous, very plugged in people in this industry, let's say. You and I hope both know who they are. Um, they're talking constantly with multi-billion dollar AUM, smaller funds, they're managing 2, 3, 4, 5, 10 billion, right? They're smaller funds that understand the story, they get the thesis, they like it, they understand that nuclear is growing, et cetera, et cetera, et cetera. Yet they're still kind of on the sidelines here. Why? Insufficient liquidity in this market. So in some cases, the size of the uranium market, which is very small here, and honestly, it's probably somewhere in the 50, $55 billion range right now. Maybe a little bit more because of the number of companies, but obviously we've had a pretty big pullback from the recent highs. So the size of the industry is still very, very small, liquidity concerns. And then they're also waiting to see some evidence in a shift of momentum to the upside. They don't want to catch that falling knife too, especially if they don't get it. So for me, I get it. I've got my models on the other screen here. I'm looking at what I'm looking at. So my conviction is very high. I'm catching that knife and I'm buying. I have been buying over the past week relatively aggressively, personally, including today. So I understand where this is going to go. I don't care if it doesn't go next week. I really don't. But some of these larger funds that have five options, Cameco, NextGen, one of the ETFs, but maybe Denison or Paladin, they got minimal options. They need a certain amount of liquidity there, and they need to see evidence of a turn. So when it bottoms, what we need to see is a bottoming and a stabilization in the price across the equities. Then we're going to start to see more accumulation, and then we'll start to move back to the upside. Right now, it's not happening. It's just full on shoot first, ask questions later. That's what we're seeing in the market right now. So more liquidity coming in, an evidence of a bottom and a resumption of an uptrend, and then of course evidence of the price moving back up. And It's like, Justin, the term price hasn't really moved down that much. Yeah, I know. And yes, that's the real market, but everybody watches the spot market for better or for worse. Doesn't matter how often I talk about it. Doesn't matter how much Mike Alkin, says that the spot market is BS. Like, it still matters. It matters to the utilities because it references their contracts. It matters to the equities because that's the only freaking thing we can see in this opaque market besides the monthly term print, which just happened yesterday, and it didn't drop despite the fact that there was one term deal in the entire month of February with an unknown volume, which means it probably was small. One,
Interesting.
but the price did not fall. Very, very, very important.
Interesting. Okay, I'm going to pull up a visual representation of this just so we can see what you've been talking about. So here's the spot price of uranium, what's reported. Very, very little volume. The way you can play it is the SPUT here, SRUUF, and I've been doing the same. As this has gotten cheaper, I've bought more. I mean, this is what you're talking about, RSI 28, Here's Cameco just falling. URNM, this was looking amazing for the beta investors here. I thought I was getting a deal up here below 40, and now we're at 35 bucks. We've got a lot of support here around 34, even more around 30, although I'd be shocked if it got down there. URNJ, same kind of thing. This is hitting the first level right here at just north of $16, and then maybe a stink bid down here at 14. I don't know, but like a lot of these uranium equities, like you're talking about, this is a visual representation of it. UEC, RSI 25. I love seeing that. You just have to have the conviction to pull the trigger when it happens. That's it. That's it.
It's always interesting to do these interviews because I know that a lot of your audience is retail, and I'm sure you have some institutional interest as well. We had our members webinar last week was with Larry McDonald from Bear Traps Report, and Larry has his own proprietary capitulation model, let's call it. And he said what we were seeing, and this was in the middle of last week, and it's only gotten worse to end the week and into yesterday and today. He's said that what he's seeing in the uranium sector right now is what he calls a Category 5 capitulation, which I don't know if that's related to a hurricane and kind of categories as well. But basically, these are the environments where the Larry McDonalds of the world put money to work. And it's so difficult sometimes to weigh these things against each other, which is the Larry McDonalds and the Rick Rules and the Kevin Bambros and the funds, the specialist funds that cover this sector. I know these guys are also on, getting longer here. The contrarian experienced value investor lives for moments like this. Well, at the same time, retail can't handle moments like this. It's very, very difficult. And this will always exist. There's nothing new under the sun. Always, always, always has been the case where the contrarian value investors, they love to see market action like this, and retail just absolutely can't handle it for a second. And we're going to go through this again. This is not like a one-off. Then it's going to turn, and a lot of people who threw in the towel last week and this week are going to buy it back higher because they'll realize, oh, the thesis is still intact. The price is responding, and they'll come back in. The momentum will go to the upside, and then the smart money that's buying now is going to sell their shares to them 3, 4, 5 months from now at substantially higher prices. And it's just always how it goes. And unfortunately, you just can't change it. It is what it is. But to highlight again, Kevin Bambro wrote a great piece a couple months back on X. He's been doing these long form articles on X, which have been fantastic. He basically showed his own experience, and it takes time, right? If you're new to investing and you see red on the screen, it sucks. And if you don't manage your portfolio in a diversified manner and keep cash on hand, it can be painful to weather this out and not be able to put money to work. If you have sufficient diversification, you can reallocate funds during moments like this, which is something that I do and have done, repeatedly. But what Mr. Bambro was highlighting, which was at some point, and again, to quote like Charlie Munger, you have to act in the opposite of your emotions, right? Because your emotions are kind of like a sixth sense. When you see red on the screen, you feel a certain way. You see green on the screen, you feel a certain way. So in that sense, acting opposite your emotions. But what Kevin Bambro was writing about was like at this point now with his experience, it's not opposite his emotions. He actually sincerely feels a sense of optimism and elation and greed when the market is like this. It's not like, oh shit, I've got to trade opposite this. It's yes. And that's the point as a contrarian value investor that you want to arrive at, which is you can sell into strength, peel off and cover, and when moments are like this happen, when it's capitulation, when RSI is a fishing line, that's when you put money to work. And you don't even have to trade opposite that emotion. Your emotion is actually in line with what you should be doing. And it takes a lot of experience and a lot of repeated outcomes of that working. So for me in this market, every single time this has happened, and like I said, this is about as bad as I've ever seen it. But we've seen RSI below 30 10 times in the last 8 years. Every single time it's there and I get longer, it pays off. So until that stops working, and I don't know when that is, I'm going to keep doing that.
Yeah, yeah, I've been playing I love seeing that. And in this last couple of weeks, I do a weekend recap of all the trades I do, and the resounding theme the last couple of weeks is I've been selling gold and buying uranium, and the feedback I'm getting in the comments on Twitter, emails, for every 10 comments I get, 9 of them are telling me that I'm crazy, and one of them is like, "Yeah, I'm doing the same thing." I'm like, "Okay, I think I'm on the right track then," because usually whatever the herd does is
I
incorrect.
did exactly the same thing, Steve. And
Okay.
it doesn't mean I don't think gold is never going to go up. I have core holdings I'll never sell. I have physical and I'll probably won't sell ever or give to my grandkids or whatever. But, you know, there's nothing wrong with taking some profits in something that moved recently and reallocating into something that looks like a better bargain at the moment. And, I did the exact same thing.
Okay. Yeah. Yeah. I mean, like, this time last year, Agnico Eagle was half the price that it is today. Like, what were you hoping for? You got it. You got to pay
Yep.
yourself at some point.
Yep.
Okay, so let's get on to some more listener questions here. I could tell by the questions that we have a lot of new people into the uranium space, so welcome. Happy to have you. Patrick's asking about some secondary supply. Maybe you can do a real quick few minutes on the fuel cycle 101. We haven't done that in a couple of years, and I think that'll kind of put everyone on the same page and tackle about 8 of these questions.
Sure. Fuel cycle 101. So the end product that a nuclear reactor operates is fabricated fuel. The product that comes out of the ground is uranium. So uranium goes through mild processing to get it to a point of being triuranium octoxide, U3O8. That's the yellow cake. That's the cake in the can, the drums of the yellow powder, U3O8. That's basically step one, coming out of the ground, underground mine, open pit mine, ISR mine, whatever. The first product of that mining process is U3O8.
That's what Sput has in a warehouse that you can buy shares into.
Exactly. They're holding multiple warehouses at the conversion facilities, drums of yellow cake, literally. So that uranium has to be converted into a gas in order to be enriched. And so the natural uranium is 0.71% U-235, which is the fissile isotope of the uranium molecule. And that fissile isotope needs to be enriched further in order to be manufactured in the fabricated fuel, with one exception, which is CANDU reactors, heavy water reactors. They operate on unenriched natural uranium. It still goes through the conversion process and the fabrication process, but it doesn't have to be enriched, which is very cool. It's about 10% of the world's reactors, or CANDU. So it gets converted into a gas, UF6. At this point, it's still 0.71% U-235, but it's now in gaseous form. And so Russia is the biggest player in conversion. They've got, high 20th percentile of global capacity of conversion. The West has two primary converters, Port Hope, which is owned by Cameco, and Orano, and they have conversion facilities in Europe. The Chinese also has basically every stage of the fuel cycle with very little uranium mining, which is why they're so active in Kazakhstan, why they have big mines in Namibia, why they're out contracting, is because they don't have uranium in very high quantities domestically. They do have conversion, enrichment, and fabrication. Their goal is to have sufficient fuel cycle operations to basically take care of their own fleet's growth. And they'll probably meet that goal, but they can't magically get more uranium. That's the Chinese front. So converted into a gas, UF6, that goes into a centrifuge and is enriched. The centrifuge spins at very high velocity, separating U-235 from U-238, the non-fissile isotope, until you get to a point where you're at about 4. It used to be 3.5 to 5%. Now it's more like 4.5 to 5%, sometimes a little bit more. LEU plus, low enriched uranium plus. The higher enrichment levels requires more uranium feedstock, but it does allow the reactors to operate at higher capacities or go longer between reloads. Once it's enriched, it is then deconverted back into a solid form and then fabricated into fuel. And the fuel fabrication usually comes with a deconversion service, but that whole process takes about 2 years, and in some cases longer in a market like we're in right now. Go pre-Ukraine war, if you buy uranium from Kazakhstan, it gets converted and enriched and fabricated in Russia. Maybe that process takes 16, 18 months. Now, in Western Western fuel cycle, it usually takes longer. So that's the whole fuel cycle. I realize your question is about secondary supply, so I'll touch on that really briefly. Secondary supply is basically supply that's not mined out of the ground currently, like on an annual basis. So usually the bulk of the secondary supply is what's known as underfeeding. That's when the enricher actually is operating at a lower tails assay of their enrichment process than what was dictated in the contract for the material they're actually enriching. So that means they use less feed than was provided to them from that contract, and they can sell that excess feedstock in the form of UF6 into the market. So underfeeding was about 25, 26, 27 million pounds a year leading up to the present environment. Up to maybe 2-3 years ago, it started to dwindle. The Western enrichers are not underfeeding at all. So that's 10 million pounds that was coming into the market 4 years ago. That's not in the market right now. Russians still doing a bit of underfeeding. Some other secondary supply would be small amounts of government stockpiles that are sold into the market, but that's really, really small, a couple million pounds a year, something like that. And then we have mixed oxide fuel, which is reprocessed fuel. That's primarily the French that are doing this. So all of that together, underfeeding, MOX fuel, government stockpiles being sold, all of that together right now, we model for about between 20 and 22 million pounds per year this year. Now that was closer to 30 just a few years ago. That secondary supply is going to continue to dwindle. The demand for enrichment is such that the Russian underfeeding amount that they are able to sell into the market is continuing to dwindle. And so we expect 10 years from now, the amount of secondary supply could be as little as 10 to 15 million pounds a year. And secondary supply has always been there. So for example, 93 to 2013, there was 20 million pounds a year coming from downblending of Russian depleted warheads that was coming into the market per year. Yet we still had that enormous, enormous run during that period of time. And that was just megatons to megawatts. That didn't include underfeeding or MOX or any other sources of secondary supply. So there's not much of an overhang of inventory. There's not much of a buffer of secondary supply right now.
Okay, so basically, it starts out, they pull the dirt out of the ground and it turns into yellow cake once it's refined. That's the U308, and that's what we're buying when we're buying shares into the Sprott Physical Uranium Trust. After that, you get it down to UF6 in a gas form. Then you run it through a centrifuge, bring the percentage up from 0.7 up to 4 to 5% of low enriched uranium. And then the final piece is to deconverted basically into the fuel rod. So when these companies and these utilities buy their uranium, they're essentially buying the fuel rods first, then they're buying the LEU, then they're buying the gas, and then they're buying the U308, right? So the yellow cake, so to speak, is the last one to be purchased, correct?
Typically, there is a general focus downstream because it's closest to their operations. Doesn't do you a whole lot of good to own a bunch of barrels of U3O8 and not have conversion and enrichment set up, because you can't do anything with that U3O8. It has to be converted, and in 9 times out of 10 enriched as well. So um, in some cases, you might cover your uranium first if there's a perceived supply shock there. And we have seen that in the past, right? Especially in the previous market when we had a very, very large mine being developed, Cigar Lake, flooded, and that caused a rush on U3O8. Because maybe you already had conversion and enrichment covered. But if you thought that you weren't going to be able to get uranium 3, 4, 5, 6 years from now because of this disruption, you're going to go ahead and rush into that market. Um, Even though we've seen spot buy a bunch of pounds, even though we've seen the price generally in an uptrend over the past 5 years, we haven't seen a rush into uranium by any stretch of the imagination. And when we've seen, so that same example for Cigar Lake and uranium in the previous market, similar in the past few years with Russia and conversion and enrichment. So whether or not that material has actually been cut off, which it hasn't, deliveries from Russia have continued. So last year and the year before, especially, there was an acceleration of future deliveries of Russian EUP because the U.S. utilities were concerned it would get cut off. But when there's disruptions around any source of any element in the fuel cycle, you're going to see a focus on that. So we've seen a focus on both conversion and enrichment the last 2, 3 years, and we've seen huge price spikes for both of those. I think spot conversion is up like 5x in the last 2.5 years. Spot enrichment is up 3x. Term conversion and enrichment are both way up. So the focus has clearly been downstream. And to quote Grant Isaac from Cameco, we have never seen a focusing on the downstream that hasn't led to a movement in price and a refocusing on the upstream, which is uranium. That doesn't happen. It has never happened. It has to happen. So that's what we still have in front of us. And by the way, if you are new, like Steve just alluded to, some of the questions look like they're from newer people. Congratulations. You are walking into this thing at an incredible, incredible opportunity with prices just falling through the floor. So you timed it well if you're new to this.
Yes, yeah, it took me, I got into this 3 years ago. My brother told me about it, and it took me missing 40% move for me to wake up and realize the kid knew what he was talking about. And then I started following this religiously. So, yes, you timed it perfectly. Now is the time. Okay, that hit Patrick's question on secondary supply. Oh, he's got a follow up. At what price would there be an incentive to increase supply from these secondary sources? Like,
Enrichment underfeeding is not going to increase based on price. It's based on capacity and demand. So we don't see underfeeding, increasing at all. We see it decreasing going forward, regardless of price. MOX, I mean, you could argue if we're in $150 plus that you're going to see more interest in reprocessing, and it sustains there. But it takes years to build these facilities, and there just hasn't been very much growth in the mixed oxide, the reprocessing of fuel, because it's tricky. It's chemically complicated. You have to handle plutonium. You're basically pulling the plutonium out of the spent fuel and reutilizing that, mixing some fresh fuel with it. So the Japanese have been very slowly building their own reprocessing center, but it's 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 almost less price driven and more just kind of making sure there's a bit of security of supply. I think the French developed theirs when they drastically expanded their fleet, thinking they would provide some of their fuel with MOX, which they do. But I don't really see price increasing secondary supply. Now, an increase in price eventually will shake out more inventories into the market. That tends to happen, although not in the moment. Usually when the price is rising, the sellers pull back, which was exactly what we saw late 23, early 24. But some of the speculators, this would primarily be the hedge funds that are holding, I don't know, 10, 15 million pounds here, maybe maximum. Some of those pounds will shake out when the price goes up, but hard to really call that secondary supply because that was market that was purchased. That was already supply. They came in at one point before they bought it. But yeah, hard to see secondary supply drastically increasing based on any price from those sources, from enrichment, underfeeding, or MOX.
okay. Oh, whoops. There we go. Click. Okay. Clinton has a question. He says, why has the 40 to 50 million pound deficit every year for the last 4 years hasn't affected the market? No utility seems to run out, and the market doesn't seem concerned. Where's the supply coming from?
Well, it has affected the market. The price of everything is up. So it has affected the market. Above ground mobile inventories. So in the previous decade, with the price tanking from 2011 all the way to 2016 for spot uranium, it continued to fall for another couple of years for enrichment, for SWU. Conversion, of course, dropped all the way to, I think, $5 or $6 a KGU at the bottom. It's traded over 100. It's so basically when you had that price falling, you had a lot of above ground mobile inventory that was swimming around the industry. A lot of that came from Kazakhstan. Remember, this is before they were partially publicly traded, 100% state owned. They had every incentive to ramp up production for a couple of reasons. The non-conspiratorial reasons would be there was a arbitrage on the Kazakh tenge, which was drastically depreciating against the dollar. You have costs in tenge, you sell in dollars. Excuse me. So that was the main incentive, I'd argue. The added incentive, maybe, or at least the result, was that Russian controlled material from state-owned Kazakh supply, flooding the market, destroyed the U.S. industry. The U.S. converter had to close up shop. The U.S. enricher was hanging on by their fingernails. The U.S. uranium miners literally disappeared to the point where they produce nothing. So that was the net effect of all of that supply. But of course, Kazakh depreciating. So a lot of pounds came into the market. We're talking 150 to 200 million pounds of excess mobile inventories swimming around the industry. And that's just the material that wasn't accumulated by China. So what did we happen? Let's say 2016-ish, around that time when spot bottom, MacArthur River shut down. They shut down in 2018. Okay, so they were shut down for almost 4 years. 18 million pounds of uranium per year, not produced in the market, but it had a doubling effect because Cameco had to buy that material. It was Cameco and Orano, right? So they were both having to buy material. That went a long way to clean up a lot of that in inventory. The other things that have cleaned up inventory, Sput bought 43 million pounds over the course of about 2 years. Haven't purchased much lately. Will they come back into the market? I think they will, but as of now, they're trading at a pretty persistent discount. But that was 40 million pounds. Yellowcake bought a little bit. Other speculators like hedge funds bought a little bit, and those are the easy to see elements that accumulate a lot of that mobile inventory. So if you go 4 years at 18 million, from MacArthur being cut off, and Langer Heinrich also shut down. Rabbit Lake also shut down. So mines came offline, companies disappeared. Converdyn shut down, bought up a bunch of UF6 when they did. That tightened that market. It's had an enormous effect, this deficit. And this deficit has led to a period where, because of the deficit, any material that was purchased, or much of the material that was purchased, was coming from mobile inventories rather than mined pounds out of the ground. So this deficit has led to the consuming of those inventories to the point where we have very little just above ground mobile inventory sitting in a can waiting for purchase. There are producers that sell a little bit of material in the market month over month, the BHPs. There's a couple of traders with offtakes from Uzbekistan. They've got material coming in here and there in the market, but there isn't this massive overhang of inventory that plagued the industry for years and years and years. That overhang is gone. So now what we see is when demand comes in, the price actually moves. That wasn't the case with a huge amount of overhang. You had demand, you had consistent, smaller, but consistent term and spot demand in the 20 teens. Didn't really move the needle that much. Now that the overhang is over, that demand actually does move the price. And that's really, really important to understand.
Okay, I did some quick math while we're talking here. So basically, we're burning about 180 million pounds as a planet per year.
More than that. So when you actually look at reactor burnup, you have to make a couple of calculations. One, especially on an annual basis, how many reactors are hitting the grid that year? because those initial core loads, and yes, if they're hitting the grid this year, they bought uranium 2, 3, 4 years ago. Okay, so but you have to you have to take snapshots in order to gauge supply and demand. That's just how you have to do it, even though there's so much complexity to it. But initial core loads are about 3 times the annual demand. So however much gigawatts are added this year, you have to 3x for that number of gigawatts. And then you have to do a calculation based on a assumed tails assay for enrichment. At a low tails assay, it's less uranium per gigawatt operating. At a high tails assay, it's more. Right now, we're modeling for about 475,000 pounds of uranium per gigawatt per year. So if I look at our model for 2025, we're actually almost at 200 million pounds for consumption this year if we include initial core loads at 475,000 pounds, which is about, I would say it's about a 0.23, 0.24 average tails assay assumption to get us to that number.
Okay, and there are 436 nuclear power plants on the planet?
Oh gosh, let me actually, you know what? Let me just
That was very specific. This was a number I memorized like a year and a half ago, so it's probably wrong.
Gotcha. It's somewhere in that ballpark. I can tell you exactly right now if you give me 1 second to bring this up. Let's see, 20.
I'm basically trying to come up with the average, burn rate of each of these per year, and if that's about right, then it's 460,000 pounds per power plant.
So the total operating number of reactors this year, I believe, is somewhere around 425.
Oh, 425. Okay.
Total operating gigawatt capacity is about 404. 11, almost 12 gigawatts will be added to the grid this year. And so that puts out, let's see. Yeah, it's about 200 million pounds of demand this year based on our tails assumptions.
Okay. All right. So for 400 to 450,000 pounds for each one to burn each year, if they were all the same and averaged out. I guess my point is that sitting on site of each of these nuclear power plants, they have between 2 and 3 years of supply just right there, because it's such a pain to shut these things down and then turn them back online. It's not like, just flipping a switch. So if there's been a shortage of 40 million pounds a year, then what happens is instead of this power plant having 3 years of supply, now they've got 2 years and 7 months averaged out over all of them. And so it could take a little bit of them kind of realizing that and then hitting the buy button. Is that accurate?
Yes and no. So the inventories are not necessarily held on site. They'll usually keep at least one core load on site of fabricated fuel for the next reload or two. That's the minimum that they'll keep on site. The rest of the inventories are typically held at conversion facilities. Or are somewhere along the fuel cycle. So uranium and UF6 are held at conversion facilities. Usually that material is only shipped to the enricher about 6 months before that material is set to be enriched. With some exceptions would be the Russians. They actually will accept return feed. So they'll send you the EUP. You send them the UF6 in return, which has been another, disruptor with the possibility of Russian material being cut off. So that's one aspect. But yes, to speak generally, 2 to 3 years is about average. Now, the Chinese will keep more because they don't have a lot of uranium and they're growing their fleet so incredibly fast. The US usually is closer to the 2-year range. They're a little bit under that right now, which we should see when the numbers come out in June. But the deficit that we have to highlight as investors in the space that you would based on, looking at supply and demand of any commodity you might want to be long or are long or a short, whatever. You want to know what the general supply is, what the general demand is. These projections are not really a concern whatsoever to utilities. And this might come as a shock to investors because we see the graphics put out by Cameco or put out by Tribeca or put out by Canaccord, whoever it might be, and say, okay, you guys, this looks like a problem. Utilities have always had what they needed when they needed it. not necessarily at the price they wanted, but they have never experienced one moment in their careers, even if they've been in this industry for 50 years, where they came into the market and they couldn't get what they needed. So these projections by the investing community, or even by like Trade Tech, which is a nuclear analyst and consultant, it doesn't mean like you're a fuel buyer and you see this graph put out by Trade Tech and you go, oh, damn, I better come to market right now. That's not how they operate. Okay. They buy what they need to buy when they need to buy it. And they will step in the market, in and out of the market based on price trends because they have some inventory to allow them to do that. But they aren't looking out into the future at projections, especially when we're talking 5, 10 years out, and saying, uh-oh, we've got a problem. Time to come to the market right now. Now, that's to speak very generally. Obviously, the Chinese are thinking differently. Not only are they thinking we're shooting for 200 gigawatts by 2035, which they're not going to hit, but they'll probably hit 150, and they're at 58 right now or whatever. An insane amount of growth. And they can see this and they understand, which is why they're scouring the earth for projects and signing very, very large mega contracts with Kazatomprom. The Chinese were 40% of the term market volume last year, 40% of it. So they are operating in a different manner than most of the global nuclear utilities. To speak very generally, they generally move when they need to move. And when the price spikes like it did last year, they're going to step back. And that's what they've done. And the price in the spot market has settled back down. The term price has stayed solid, moving sideways for the last 6 months. Very good sign. But generally speaking, they will buy when they need to buy. They'll buy what they need to buy when they need to buy it, regardless of the price. And the only thing that really changes that on the uranium front is a big disruption. So just throwing it out there, the market balancing late decade, early 2030s, theoretically, is from very, very large projects that may or may not come online on time. Arrow, Phoenix, these projects are greenfield. They have not put a shovel in the ground yet. If we see any delays in either of these projects, especially Arrow, so I can tell you right now, there are fuel buyers that think everything is fine because of Arrow. Like that's just the way that they're thinking. And it isn't, but that's what they think. And so any sort of delay or disruption in that development could be kind of like a Cigar Lake sort of moment for this market.
Okay. I look forward to that. Benjamin and a few other people were asking about, did a recent interview with Warren Irwin, and he says Warren Irwin has argued for years that there isn't a real uranium deficit. Pounds always appear when needed, especially from the spot market. What are your thoughts?
So I did watch your clip with Warren, and first of all, I very much like Warren, and he's completely entitled to his opinion. And he is right that uranium is sort of always there. It's at what price is the big question mark, right? So his numbers were pretty significantly off in terms of what has been accumulated by the quote unquote speculators. If we look at hedge funds, Sput, Yellow Cake, the buying they've done in the past, let's say 4 years, has been about 50 million pounds. I think he said 120 million, if I recall correctly. So it's been about 50 million pounds. Some of that can come back into market from the hedge funds. As of now, Sput isn't planning on selling or any of those pounds shaking out into the market. The only way that could happen, to my understanding, is it would have to go to a shareholder vote. And that would only likely happen if they were actually bought out at whatever premium shareholders would actually approve, right? So that's so hypothetical. It's not going to happen, in my estimation. So as far as pounds always being there, yes, there is a lot of uranium in the world, and there always has been. And you have to keep in mind the price uptrends that we've seen historically have all happened in this same world where there's a lot of uranium. What really matters is, will the buying pressure surpass the availability at these prices? 100% guaranteed that it will. Where the utilities are really uncovered right now is in the 2030s, and this industry lives in the future, okay? It exists 5 years from now. That's just how it operates. Are there short-term disruptions? Yes. Are there any utilities that are uncovered for uranium in 2026? Yeah, there's a couple, okay? But it's not like all the utilities have to slam into the market because they're not covered 2, 3 years from now. It's not how they operate. So when we take a snapshot of what this looks like in the 2030s, first of all, for the projects that come online to theoretically balance the market, we need higher prices. So that's the first very obvious statement, right? Arrow and Phoenix and DASA, are they going to make money at $80 term? Yes. Okay. Are they going to continue to progress towards development? Or DASA is being developed. They're probably going to produce, not on time, but they'll produce. Phoenix and Arrow, we'll see how that goes. They likely will progress based on these prices, okay? But at the same time, they're not stupid, okay? They understand, especially next gen Arrow or whoever builds that mine, wink, if they come into the market in 2030 with 29 million pounds of uranium, which may or may not happen, if they contract out much of that at these prices, it's going to stem the price, and that's going to influence the stock in certain ways, right? So, but those are the price, not that price insensitive, but the lower cost projects that are likely to progress into development regardless, not regardless of price, but at these prices. Then we get into Tumas, Etango, an expansion of production in the United States from Utah, Wyoming, Texas, especially Utah. Nothing's happening in Utah at $80 term. It's just not. Okay. Big underground mines in the Athabasca, anything else in Namibia, low grade stuff in the US, none of the stuff is happening at these prices. Now, Deep Yellow and Bannerman are going to tell you that they're going to go into their final investment decision this year, and they're going to move towards progression and development. There are major water issues in Namibia right now, and these prices are not sufficient to put $500 million at risk, if not more, to build these mines. It's going to take years and years and years to build, and a lot of money to build, only to find yourself into a market that you can barely make money at. That's not how this works. And Borshoff knows it. And he even delayed things a couple months back, saying, we're not seeing the market where we want to see it in order to bring this mine. So what we have is a market that will not balance without higher prices in the near term. That's between now and 2030. When we go out into the 2030s, what do we see? We see Cigar Lake is done by mid 2030s. Even phase 2 is done. MacArthur River by the late 2030s. Rossing in Namibia is done. 4 Mile, which is producing right now in Australia, that's done in the next 5-6 years. Half of the projects in Kazakhstan are done by 2036, 2037. And by the way, when I say done, that means they're not producing anymore. 2030, to that point, decline rates. So we have to see enormous investment. Look, I'm going to bring up my model in the background again. The demand for uranium, our projection in 2035 is almost 300 million pounds of uranium.
Wow.
Almost 300 million pounds of uranium.
Okay.
We see close to 100 million pound deficit in 2035. 100 million pounds. So what I'm saying is we get to higher prices and we see the market balance for this point in time in 2030, 2031, that balancing is almost irrelevant because of how the industry exists in the future. So utilities are already starting to contract in the 2030s, even into the mid 2030s. Not very many are contracting into the late 2030s. But when we see volumes come into the term market for this period of time, it's going to be a pretty quick realization that the pounds are not there in sufficient volume because these projects don't exist yet that are going to be needed to fill that massive gap. And that almost 100 million pound deficit in 2035, this includes no demand from SMRs, zero demand from SMRs, okay? We have modeled nothing for SMRs besides what's literally being built right now, which is like TerraPower's Natrium and a couple BWRXs in Ontario. There's a few others globally, but we see this huge move, this big momentum for these things, and they haven't even started to hit yet. So We've got a problem between 2035 and 2040. We've got a problem in the next few years. If prices are high enough, and if multiple projects come online between now and 2032, we might have a balanced market for a point in time. But I can tell you right now, in the world of uranium, a mine has never been built on time, on budget in this industry. It hasn't happened yet. So if you think it's going to happen now, when there's an extreme shortage of skilled labor that can actually do this stuff, and at 80 bucks a pound, you got something else coming.
Okay. Let's see. Got several questions here, kind of all similar here from Den, from Jeff, from Listen Guy. They're basically asking, like, why doesn't an authorized buyer? We can all see on the screen the spot price is 64, 65 bucks. Term price is 82, like you said. Why aren't some authorized buyers basically running the arbitrage that I am with Sput, but on a bigger level?
Sure. Well, first of all, you have to consider, even speculating on a small amount of pounds in the spot market is pretty expensive, right? So you're talking 100,000 pounds, you're looking at what, $6 million, $6.5 million. It's just not in anyone's incentive to speculate on this, besides perhaps funds, besides perhaps people buying spot. And there is, okay, you can't see it because the selling pressure is breaching the buying pressure here, but there is accumulation happening. I can tell you 1,000% that quote unquote smart money is buying here. 100%. As far as in the physical market, there's no incentive here for anyone to try to catch a falling knife or to bring demand into this market right now because they think it's the bottom. It doesn't matter whether they speculate on it, because you have to understand most fuel buyers don't really have a lot of rope. Okay, they have to take what they are seeing in the market and make a case to their management, who has to go through board review and their budget and looking over their balance sheet and what their expenditures for the year in order to approve. Say, I think this is a good place to cover. Let's come into the market here. They can't just do that. They have to convince management of that. Which, by the way, if you tried to do that at 95 after it fell from 107 and then 90 and then 85 and then 80, you get my point. There's no reason to think that you're at a bottom and come in and buy physical. Same thing with the traders, and the traders will do it a little bit, but it's not the real organic demand that we want to see from utilities coming into both the term market and the spot market. And it's going to be mainly the term market, but we will see some spot market action on the behalf of utilities, even potentially producers. There's multiple producers that are a little bit short. So yes, we will see speculation, but it's usually not in the incentive of pretty much anybody to buy physical uranium trying to time a bottom. It's more of a trend and a momentum situation, especially for utilities. When the trend is down, they step out. When the trend is up, they step in. And the opposite is the case for the sellers. Maybe you have a little bit of pounds. You're a trader. Maybe you're a developing company. You've got a little bit of pounds. Maybe you're a hedge fund. You're holding on to some physical. You pull back when the trend is up. Because why sell now if you can sell more next week at a higher price? And that's the mindset in the uptrend, and it's the opposite in the downtrend.
Okay, alrighty, that hit Marion's question and King Cap as well. We're knocking them out here. Let's see. Could spot arrange. No, you hit you big bull. I like his name, you big bull. He hit his question. Okay, here's some geopolitics and policy impact. We've got several questions on Russia. Would a peace deal with Russia and their access to fuel manufacturing services ease this bottleneck? I mean, you can pontificate on that. How will Trump's tariffs affect uranium stocks, spot prices, jurisdictions? Maybe kind of talk about the dynamic between our new administration, the Kremlin, and how that relates to uranium.
Tariffs should have an accretive pressure on the price. I don't think this is one of those things that's just going to, quote, hurt Cameco, unquote. I think it's actually going to influence, because Cameco and Orano are such big players in Canada production and global uranium production, it's likely to influence the price generally to the upside. As far as a peace deal with Russia, that is, in my estimation, going to be a net positive. And I'll tell you why. This is a global market. So demand for Russians material hasn't dropped, globally speaking, in the past 3 years. There has been a move away from engaging in new business with Russia by certain Western utilities. But if we look at the big story about this is the US and Russia, right? Which is the US instigated a ban that went into law last August. So far, there have been waivers given to Centrus on behalf, as a broker of material, on behalf of some utilities. But this is 100% ban in 2028. Now, for that to go away, it'd have to go to legislation. And remember, this was passed 100% bipartisan. So could it be legislated, and could it end up passing the House and Senate to reverse the ban on Russian material? I suppose it's possible. It seems unlikely, and it doesn't seem to be aligned with Trump's America First type way of being and policies, to speak very generally. So more than likely that will remain in place. Russia's embargo of material has also granted one-time licenses to the last couple of deliveries so that they could continue to ship that material. Now, what peace will bring in Russia, and this is assuming a couple of things, assuming that at the very least the Russian suspension agreement stays in place. If that were to be altered, that would also have to go through legislation. So this is something that limits the amount of Russian material that can come in the United States as a percentage of overall demand out to 2040, and it declines from here to 2040. Right now, I think it's somewhere around 25% of demand can come from Russia under the RSA. So assuming the RSA remains in place, and perhaps the ban remains in place also, peace in Ukraine and a peace deal between the US and Russia is a net positive, because what it means is clarity for utilities. Okay, if you're outside of the US, that means you can re-engage in business if you have neglected it. Now, Russian capacity is what it is. And it has, like I said, demand for their material and their services hasn't dropped, to speak globally, in the past few years. So this ending is a net positive for clarity for utilities. And that is the number one thing that is holding utilities back, is clarity. It isn't price. It's what's happening to my next delivery and what is happening 1, 2, 3 years from now. If there's clarity there, that's a net positive. Of course, we should all hope for an ending to the war from a humanitarian perspective. But what comes out of the peace deal, those are the details that I think is scaring investors. And I think it's worth visiting for a second, because we need to go back and look at megatons and megawatts. First of all, this is a very different world where this is essentially a strong arming of Russia to denuclearize. And at that time, they had over 40,000 nuclear warheads. Many of those active, some of those retired. So what they did over the next 20 years was downblend the equivalent of 20,000 warheads into low enriched uranium that was sold to the United States nuclear fleet. Megatons and megawatts, an incredible source of secondary supply for many, many years. So what are we looking at right now? The US, okay, so from that time period, basically from the 60s, when they stopped building up high enriched uranium inventories and building warheads, it has only declined. Neither country between the US and Russia has been building up HEU stocks, okay? It's only been declining. Between the US and Russia, in the early 90s, 60,000 plus warheads. Between the US and Russia right now, 11,000 warheads. Many of them are active. Many of them just can't be downblended like that. Some of the retired ones theoretically could be. US military inventories are historically low right now. So to the extent that the United States will maintain an arsenal of nuclear warheads and or a nuclear navy, it is highly unlikely that any material amount of HEU or warheads will be downblended. Russia has a bit more than the United States, but the revamping into that process would take some time. And I don't think it's going to be something similar, if it's anything, in a denuclearizing pact between the countries. Also, I don't see US and Russia doing this with China over here building their nuclear arsenal. We end up seeing peace between the US and Russia, yet China over here is not part of this. That seems extremely, extremely unlikely to me from a geopolitical perspective. So, with all of that said, could theoretically Russia downblend some retired warheads into low enriched uranium? Yes, they theoretically could. Could it be anywhere near the volumes that we saw before? No. The numbers just aren't there to support that. So, theoretically, could it happen? Yes. Now, I think the most likely thing to happen, if there is some kind of deal like this, is the production of HALEU. And the reason why is much of the United States momentum and incentives that have been put forth by the government in the past couple of years for new nuclear in the US is all around advanced nuclear and SMRs. Advanced nuclear, different designs that typically will run on high assay, low enriched uranium, which is pushing 20%. It's higher than 5% and below 20. Usually it's in the 19th percentile of enrichment. The US is producing basically zero HALEU right now. We don't have the ability to do it. Centrus has a single circuit that is now dedicated to HALEU, and they've produced a few hundred kilograms of HALEU to this point. When that circuit reaches max capacity, it will take Centrus 10 years to produce enough HALEU for the first initial core load of the TerraPower's Natrium reactor. So, who is the other player in the world that's producing HALEU right now? If you guessed Russia, you're correct. So, Russia could potentially do some downblending to check that denuclearizing box and be producing HALEU to serve not only the growth of SMRs in the US, but growth of SMRs generally. This is all speculation. We don't know if any of this is actually even going to happen just because Trump said, we're going to do this in a big way. You know, as he says, everything's in a big way. That's a terrible Trump impression. But you get it. Everything is in a big way for Trump. So is this going to happen? I don't know. Could it be anywhere close to megatons and megawatts? No. The numbers, the HEU inventories, and the retired warheads are not insufficient numbers to do this. I don't think the U.S. is going to downblend anything because I think we need that material for the growth of the nuclear navy and going forward potentially for HALEU production. So all of that is to say a lot of fear around all of this, what this actually could look like and how quickly. I don't see this being as any sort of market disruption whatsoever in the physical side. We'll have to see how it plays out. But peace in Ukraine, peace with Russia between the U.S., net positive for the world, net positive, hopefully for the world, net positive for clarity for global nuclear utilities to move forward.
Okay, so as far as the uranium ban that was going through Congress and everything got passed, you don't see any of that being reversed. Like that bet is still on. It would take an act of Congress to undo it, so that's happening. Peace would provide a lot of clarity to the term market, which is something that Rick Rule's been talking about for a while, is that, you know, these markets are pretty opaque. And unless you have access to the resources you do, the average guy is pretty clueless to it. So peace would be good because now we'd actually be able to see what a lot of these long-term contracts are doing. Banks would be a lot more apt to lend because they have clarity as far as what the pricing is. And then when it comes to this down blending, which apparently just spurred a 10% sale off from a Trump tweet, you don't see this being very likely. If it actually does happen, it's minuscule and it will take years to come out, and it's probably not going to affect the market.
If it happens, it'll be immaterial to the overall thesis.
Okay. All right. Okay. A couple of questions here. Investor Joan and sardines for sale. I love some of these handles here. Okay, basically asking about the German election results, potential impact on uranium demand for reactor restarts. Have you studied this at all? The new German government's nuclear policy. What do you see happening in Germany?
There's been mixed messaging from the party that won the election, but the new German chancellor did state yesterday that we immediately have to engage in a moratorium on the decommissioning of the nuclear plants. So basically, what he's saying is put down the sledgehammers, which could be a sign towards restarting some of the reactors. Otherwise, continue with the decommissioning if you have no plans to restart them. So attempting to halt the decommissioning leads me to believe that they might have some kind of plan to at least entertain the idea of restarting. The few reactors that were shut down just last year could be restarted relatively easily. There's a few more that would take a little bit of an investment. I believe Mark Nelson and his team at Radiant Energy Group did say that I think there were 7 or 8 German reactors that still could be restarted. Obviously, some of those have been partially decommissioned, so it would take some investment. But for the new chancellor to say, halt, let's turn the crane off, let's put down the sledgehammers, that's a good sign. Not holding my breath, but looks positive.
Okay, if they did, they shut down 3 that they could restart pretty easily, right?
The last 3 that were shut down last year, yes, are not in advanced stage of decommissioning.
Okay, and how many others could be on the books that are potentials here?
My understanding is there would be an additional 4 to 6, if I recall correctly, from Radiant Energy's report.
Okay, all right, so 7 to 9 total, possibly. Do they have fuel on hand to do this, or did they sell that to the open market?
Oh no, they'll have to come back to the market.
Oh, perfect. Okay. And how much additional demand would that create? Is it factored into current supply demand forecast? Doesn't sound like it. Huh?
That I don't know. I'd have to go back and look at the capacity. I mean, we could, I wouldn't want to discount all of the potentials coming back online. I think the low hanging fruit would be the first 3. So we could say initial core load for, ballparking 3 gigawatts is going to be 4.5 million pounds of demand. That would be near term.
Okay. All right. Cool. Times 3 years and then.
Don't hold me to that number, but it's somewhere. Let's say 4 to 5.
Okay. All right. Cool. Let's see. Craig wants to know, what does Justin think of the fission acquisition by Paladin?
Well, I don't see a super clear path on PLS developing. It seems like the previous management team had primarily been kind of riding this theory that the more advanced Aero and Next Gen would have to collaborate with them on mill construction. That doesn't seem to be the case. I mean, generally speaking, I think the sector needs more M&A. So I'm happy to see it. I do think that the Paladin team has done a pretty good job with the restart of Langer Heinrich. So I think a management change is probably a net positive.
Okay. All righty. It's good to see it. And yeah, and they're right next to Next Gen. So whoever should build those two together, right?
Yeah, I mean, there's obviously going to be more infrastructure that isn't a mill that's going to be built, roads and things like that. So it's possible that they could work together, and that's been something that's been theorized for the last 5 years. But I haven't seen any evidence of it yet.
Okay. And last one, Human wants to know. So he's talking here about underfeeding and overfeeding, right? So we talked about it before about the visual representation you gave of the lemons, right? Squeezing the lemons. If you just squeeze it real quick, you get juice fast, but you leave a lot still left in the lemon, right? Whereas squeezing all the lemon juice that you can possibly get out, when you toss out that lemon peel, there's almost nothing left, right? So that's basically what we're talking about here. He says, after the lemons are squeezed and the juice is delivered, who owns those leftovers? And this is what happens with overfeeding, right? So like, where does that go? Is it kind of put in a stockpile for later use, or what happens to it?
So he's asking who owns the depleted tails, basically.
Yeah.
Yeah. And my understanding is that they're owned by the enrichers. I could be wrong on that, but I believe that they're owned by the enrichers. Re-enriching tails material was another source, and is maybe a little bit in Russia, another source of secondary supply. So it's underfeeding is when you're operating at a lower tails than the contract dictated the feedstock to be delivered for that process, and you just sell that extra feedstock. Tails re-enrichment is literally taking those tails and re-enriching them back up to natural uranium at 0.7 and selling the UF6 into the market. And a little bit of that is still happening in Russia. There's zero tails re-enrichment happening in the West. There's zero underfeeding happening in the West. So any underfeeding tails re-enrichment coming from Russia, but not a lot because there's been so much demand for enrichment that both of those processes are a result of excess capacity. When there's way more capacity than demand, it's not an easy, you don't just like flip a switch and turn off a centrifuge. These things are operating at very high speeds for very long periods of time. So you'll utilize that excess capacity to just take some of the waste over here and enrich it back up to natural uranium and sell that material so you can get some income happening when the demand for your enrichment services is lower than your overall capacity. That hasn't been the case for years. So generally speaking, underfeeding tails re-enrichment have dropped in the past years and will continue to drop from what we can tell.
Okay. All righty. Well, I think that about wraps it up. Justin, thank you very much. If viewers want to get a hold of you, follow your work, what can they expect when they sign up with you at Uranium Insider?
We cover the sector extremely in depth, and we live, eat, and breathe this sector. So I've referenced our modeling multiple times in this interview. Our members are going to see some graphic representations of the results of that modeling in next month's newsletter. So our work gives us confidence in going forward in this market, and there's nothing more valuable than that, because when you see market conditions like we're in right now, you know what to do. If you don't understand what's ahead of us, you see these conditions and you go, F it, I'm out, it's over. If you do understand, you say, the market probably has it wrong, and I'm going to get longer here because the future looks bright for this trade. That's absolutely crucial. So we focused very heavily in the physical market. We want to know what is out there, who's buying and who's selling. We keep a very tight grasp on exactly what's happening there. And then, of course, we're out to these conferences, we're traveling, we're speaking with industry execs. We try to take the enormously complex world that is nuclear and uranium fuel cycle and distill it down to what you need to know as an investor. And that gives our members confidence in how to act in these extremely volatile markets.
Awesome. There will be a link down below and a link in the pinned comment below. Justin, thank you very much for coming on the show. It's always a pleasure.
It's always a pleasure talking with you, Steve.
Yes, and thank you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.